Hey guys, welcome to Stock Talk with Mike. I want to talk to you about a company today that I've touched on in a few videos, but I wanted to look a little deeper into C Limited. I think this is one of those companies, in my opinion, is a gotta hold over the next 10 years. I see this being a much larger company. They're in the e-commerce space in Southeast Asia, but also in the digital payments and financial space, and also digital entertainment and gaming. So if you like this kind of content, if you want to follow along with me, please consider subscribing to the channel. It'd be great also if you like this video. C Limited, ticker SE, is based out of Singapore, and they serve all of Southeast Asia. So think Thailand, the Philippines, etc. And that population totals that they serve is over double that of the United States. They're a pretty large company already with about $122 billion market cap, but they're growing faster than a lot of startups. They're growing incredibly quickly. They offer an online gaming platform, and with their biggest game, Free Fire, which is incredibly popular. It's one of the most downloaded games worldwide the last couple of years. And that's a huge cash cow for them. It's put them in a really good financial position. And they continue to work a lot on research and development in the gaming space and developing new games. And their e-commerce platform, Shopee, is now, so they really started in the gaming space, but their e-commerce side of things has been growing even quicker than their gaming and is now over half their business. So that's an area that is just going to continue to exponentially grow moving forward. And then they're also in the digital payment space with C Money. So they actually just recently received a bank charter in Singapore so that they'll be able to offer more financial services. When you look at their revenue growth history, you see how they came out of almost total obscurity a few years ago to being over $100 billion company today in record time, really. So in 2017 here, they had $414 million in annual revenue. That jumped up to around a double in 2018 to $827 million. And then in 2019, it increased from 827 up to 2,175,000, and that was because of the large shift towards e-commerce and as well as the popularity of Free Fire in their digital entertainment space. And then again in 2020, we saw that number basically double again up to 4,375,000, and then they're expecting over 100% growth in e-commerce and continued growth in their digital entertainment space in 2021 as well. So nearly 100% growth there again. So we're just seeing this company scale up incredibly quickly. See, just reported some great numbers for Q4, but I just wanted to highlight just the full year 2020 numbers and also look at the guidance for 2021 because that's what we care about, where this company's going. And this is just looking at the full year 2020 versus full year 2019. Revenues grew from 2.2 billion up to 4.4 billion. That's a 101.1% year over year increase for the full year GAAP revenue. And the gross profit actually grew 123% to 1.3 billion. They're not profitable on the bottom line, but it's good to see this gross profit heading in the right direction. Obviously, massive growth with 123%. And looking specifically at the digital entertainment, so the gaming side of things, full year 2020 grew 80% up to 3.2 billion. So that's obviously a significant portion of their business. E-commerce grew 159.8% to 2.2 billion. So it's nearly half the business at this point and expected to grow faster than digital entertainment moving forward. So that's going to become the largest component of their business. And if we look at their guidance they provided for the full year 2021, they didn't provide totals as far as revenue guidance, but they did give some guidance for digital entertainment and e-commerce. So sort of their more developed industries in. But I'm really interested in seeing where they go on the digital payment and banking side of things as well, digital payment, as they've got their license now as a digital bank as well. So digital entertainment is expected to grow 38.1% year over year. Based on the midpoint of the range, that would be 38.1. So that's a bit of a deceleration, obviously, in revenue growth, but I think that's because I think there was a lot of built-in growth during the pandemic as people were spending more time gaming and whatnot. But they do expect their e-commerce to basically sort of overtake as share as far as their revenue. And overtake the digital side of things in 2021 with an additional 112% growth between 4.5 and 4.7 billion dollars in revenue from e-commerce through Shopee. So that's incredible growth moving forward. You put those together and you think about the continued growth on the digital banking side of things. I would expect revenue guidance really to be in the range then of about 80% for all products as far as revenue in 2021. So that's just incredible growth moving forward. And I wouldn't be surprised if they beat on that and are closer to 100% growth in 2021. C is another one of those high flying growth stocks that just shot to the moon in 2020 and then saw a little bit of a sell off here in 2021. I think a really nice healthy sell off as all these companies were getting a little ahead of their skis. And I think creating some really good buying opportunities. There might be still more downward pressure, but when you have these good companies on your watch list, if you haven't had an entry point, these kind of sell-offs are what you're looking for. When we're seeing 20% or more sell-offs from the all-time highs, these are good entry points for a starter position where you can start dollar cost averaging in. So they reached an all-time high of about $285, currently trading at around $235 a share. They did even get lower than that. So they're still about 20% off all-time highs. I did pick up more. I've been in C since I think August of 2020, where I bought it at $120 a share. And then I actually bought more on the big pullback we saw. I got in on March 10th at $216 a share with some more shares. I want to walk you through my 5-year price prediction for C Limited, but just a word of caution with these. Obviously, a lot can change over 5 years from a market sentiment standpoint, like we've seen recently, which can drastically impact the valuation or what investors are willing to pay for a given company. Like we've seen with growth stocks where that we've seen sell-offs as high as 40% or more in some of these high flyers without any real changes to the underlying company. So that's really just driven by market sentiment. And obviously the underlying business, a lot can change in 5 years to the positive or the negative, right? They could have new product categories that they move into that drastically change the business model, or antitrust regulations could come down on them, negatively impacting them. So there's a lot that can change that really just could blow up any predictions like this out of water. But at the same time, I find it useful to look at the current business and where they could go as far as where their profit margins could be, where the valuation could be, and where that share price could be as well. So I find it very useful. So current share price is $234.99 a share. Number of shares outstanding is 519 million, which gives us our market value currently of 122 billion. Revenues right now for the full year 2020 anyway, were 4.38 billion. Expenses quite a bit more than that, just over $6 billion. So they have a negative net income currently of $1.6 billion. So that's a profit margin of negative 37%. But they're actually quite healthy. They have $6 billion in cash right now on the balance sheet. So they're in really good financial shape for 2021. So they're definitely not profitable right now. And so we look down at the expenses currently. I have a breakdown of the current expenses and the percentage of their profit margin or expense margin that they take up. And I made some predictions into beginning of 2026 of where I think these numbers could be. And I think it's possible to get the cost of sales down to the low 50s, looking at similar comps like Amazon, but also like Alibaba I used to look at these comps. And I ended up coming up with an expense margin of 75%, which would put them at a profit margin of 25%, which is fairly comparable to a company like Alibaba currently. For revenue growth, over the 5 years, I used an average of 45%, which I think is very realistic. Given that they had 101% revenue growth in 2020, and their guidance is for over 80% revenue growth in 2021. So that's almost 2 years of that growth rate already baked in. So even if they saw a drastic decline in revenue growth for the last 3 years or so of this model, I still think 45 is a very good average to use for over the 5 years. That would up there. So just at a 45% revenue growth over 5 years with current revenues of 4.38 billion, that would get us up to over $28 billion in revenue by 2026. So that would be $28 billion for the full year 2025. So it's incredible how this compound annual growth really changes the numbers over time. So when you plug that in, so I said again, that would be a 25% profit margin of these numbers. And I used a PE. This is not a forward PE, right? This would be a trailing PE. I use 45. Amazon's currently is over 70, right? Alibaba's is lower. But if they have it's kind of in the, I think around the 30 range, or maybe even the high 20s for a trailing PE. But with a 45 PE, with this kind of earnings growth, their forward PE, which is what most investors look at, would be in the mid to low 30s. So that would be a very respectable PE, so a low valuation. So I think we're on the conservative side here. That would ultimately work out to a share price of $607.86 in 2026, beginning of 2026. That would be a total return of 159% and an average annual return of almost 21%. So that's pretty good returns. And this could be different. I think revenue growth could certainly be higher than that over 5 years, but I think it's a pretty realistic number. And it could definitely trade at a steeper valuation, right? You put in a valuation more similar to, say, Amazon here. So we up this from from 45 to 70 and see what it does to the number. All of a sudden we have a $945 share price with a total return of 302% and 32% annual return. So drastically higher. So I think this is a really good buy right here with C Limited. And I was really happy to pick up more shares on this growth stock tech sell-off we had recently. So there you have it. As you can tell, I obviously really like C Limited, and I was really happy to be able to increase my position size. And I think this is going to be a company I'm going to be holding for the long term. I talk a lot about e-commerce companies. I just think it makes a lot of sense to have some pretty heavy exposure to that space, especially internationally. It's an opportunity to broaden outside of the US borders as far as diversification of your portfolio as well. And I just think there's a lot of opportunity out there, and they're in all the right spaces as far as digital payments and entertainment or mobile gaming as well. So I really like that. They're also recently expanded into South Africa as well, where they're competing directly with another company I talk quite a bit about, which is Jumia Technologies, which serves a lot of different parts of Africa. So that's kind of interesting leg of growth for them as well. It'll be interesting to see if they continue to move into other markets. And they're obviously executing very well. Like they're growing incredibly quickly, and those margins are coming in as well. So I'm really excited about the future for C Limited. Anyways, that's all I have today. So thank you so much for watching, and happy investing.